In this section, we will explore the history of, as well as the definition of mortgage fraud. Mortgage fraud has a long history intertwined with the evolution of the mortgage industry itself. Dating back several decades, mortgage fraud refers to the illegal or deceptive practices committed by individuals or organizations during the mortgage loan process. It involves intentionally providing false information, misrepresenting financial details, or manipulating documents to secure a mortgage loan or gain financial benefit through fraudulent means. The definition of mortgage fraud encompasses a wide range of activities. These can include inflating property values, falsifying employment or income documentation, fabricating bank statements or tax documents, providing fraudulent appraisals, or engaging in illegal flipping schemes. Perpetrators of mortgage fraud often aim to deceive lenders, borrowers, or other parties involved in the mortgage transaction for personal gain, such as obtaining a loan for a higher amount than the property's value, or profiting from the sale of properties acquired through fraudulent means. Over the years, mortgage fraud has adapted and evolved alongside advances in technology, changes in lending practices, and fluctuations in the housing market. Regulatory bodies and law enforcement agencies have responded by implementing stricter regulations, enhancing surveillance systems, and increasing penalties for those found guilty of mortgage fraud. Efforts have also been made to educate consumers, lenders, and industry professionals about the risks and red flags associated with mortgage fraud in order to prevent its occurrence and mitigate its impact on individuals and the overall economy. To explore how mortgage fraud became such a big problem, we need to consider the increased reliance by both financial institutions and non-financial institution lenders on third-party brokers and how that reliance has created opportunities for organized fraud groups, particularly where mortgage industry professionals are involved. Combating significant fraud in this area is a priority because mortgage lending and the housing market have a significant overall effect on the nation's economy. All mortgage fraud programs were consolidated within the Financial Institution Fraud Unit, even where the targeted lender is not a financial institution. This consolidation provides a more effective and efficient management over mortgage fraud investigations, the ability to identify and respond more rapidly to emerging mortgage fraud problems, and a clearer picture of the overall mortgage fraud problem. Each mortgage fraud scheme contains some type of material misstatement, misrepresentation, or omission relating to the property or potential mortgage relied on by an underwriter or lender to fund, purchase, or to insure a loan. The FBI compiles data on mortgage fraud through Suspicious Activity Reports, or SARS, filed by federally insured financial institutions and Department of Housing and Urban Development Office of Inspector General reports. The FBI also receives complaints from the mortgage industry at large. A significant portion of the mortgage industry is void of any mandatory fraud reporting. In addition, as initial mortgage products are repackaged and sold on secondary markets, the sale of the mortgages in many cases conceal or distort the fraud, causing it not to be reported. Therefore, the true level of mortgage fraud is largely unknown. The mortgage industry itself does not provide estimates on total industry fraud.